The four most dangerous words in the world of money, the phrase that has incinerated more fortunes than all the wars and natural disasters combined, is the simple, seductive whisper, "This time is different." It is the anthem of the new era, the justification for abandoning all common sense, the siren song that lures entire generations of investors onto the rocks of financial ruin. We hear it at the peak of every bubble. We hear it from well-dressed commentators on television, from charismatic young founders promising to change the world, and most dangerously, we hear it from the optimistic voice inside our own heads when greed has silenced the timid whispers of our better judgment. Warren Buffett, a man who has navigated more than a dozen market cycles, from the go-go years of the 60s to the dot-com mania to the financial crisis of 2008, has built a $100 billion fortress upon a single, unshakable foundation. This time is never different. The technology changes, the companies change, the stories we tell ourselves change, but the underlying engine of the market, the raw, primal, and predictable forces of human fear and human greed, remain as constant as the tides. To believe that we, in our enlightened modern age, have somehow transcended the emotional follies that have defined every market cycle since the dawn of capitalism is the height of arrogance. It is a historical amnesia that carries a terrifyingly high price. Buffett's true genius, the secret that separates him from the legions of fleeting market gurus, is not his ability to predict the future. It is his profound and deeply ingrained respect for the past. He understands that market history is not a collection of dusty, irrelevant anecdotes. It is a behavioral laboratory that has run the same experiment with the same human subjects over and over again for centuries, and the results are always the same. Euphoria leads to excess. Excess leads to a crash. The crash leads to panic. And the panic creates the single greatest investment opportunities for those who kept their heads and their cash, while everyone else was losing theirs. This is not a strategy about complex algorithms or insider information. It is a financial transformation born from wisdom. It is about developing a historical perspective so clear, so deeply embedded in your decision-making process, that you can look at the dizzying heights of a speculative frenzy and feel not envy, but a calm, patient detachment. It is the ability to recognize the recurring patterns of human folly, not with cynicism but with clarity, allowing you to sidestep the traps that ensnare the 99% and to act with courage when bargains born of terror are laid at your feet. What we are about to explore is not just an investment technique. It is a mental operating system for a lifetime of successful wealth management, a way to insulate your financial future from the madness of crowds and the expensive allure of prophecy. It begins with acknowledging a simple truth: the cycles of the market are as inevitable as the changing of the seasons. The most fundamental lesson taught by the sweeping panorama of economic history is the inevitability of the cycle. Economies and markets do not move in straight lines. They breathe, they expand, and they contract. Periods of prosperity and innovation inevitably give way to periods of recession and consolidation. This is not a flaw in the system. It is the system. It is the creative destruction that clears out the rot, punishes the reckless, and lays the groundwork for the next healthier phase of growth. While most investors ride this roller coaster with their eyes closed, alternately giddy with euphoria and screaming in terror, Warren Buffett views it with the calm, steady gaze of a farmer studying the almanac. He is not surprised by winter. He expects it. He prepares for it. And he understands that winter is not the end, but a necessary precursor to the next spring. His masterful handling of Berkshire Hathaway, the company that began as a failing textile mill, is the ultimate foundational anecdote for this principle. It wasn't a sexy tech stock or a high-flying financial firm. It was a business standing directly in the path of a long, grinding, and irreversible historical cycle. In the mid-1960s, when Buffett took control of Berkshire Hathaway, the American textile industry was already a ghost. The looms were falling silent all across New England as production inexorably moved south, and then overseas in search of cheaper labor. The industry was in a terminal, multi-decade winter. The 99% of managers in that situation would have fallen for the "this time is different" trap, but in a different guise. They would have tried to fight the tide of history. They would have said, with new management, with a little more capital investment, we can be the exception. We can revive this great American brand. They would have poured good money after bad, chasing a nostalgic vision of the past, all while the powerful, impersonal forces of global economics were grinding their life's work into dust. Buffett did the opposite. He had no romantic illusions. He studied the history, he looked at the numbers, and he accepted the brutal reality of the cycle. He knew the textile business was doomed, so instead of trying to be a hero, he became an undertaker. He ran the business with ruthless efficiency, but not for growth. He ran it for cash. Every dollar that wasn't absolutely essential to keep the looms running for one more day was pulled out of the textile operations. He refused to make significant new capital expenditures on equipment that would be obsolete in a few years. He was harvesting the business, not growing it. This was an act of profound intellectual honesty, an acceptance of a historical trend that was bigger than any single manager or company. While other textile executives were petitioning for tariffs and dreaming of a renaissance, Buffett was using the cash flow from the dying textile mill to buy into a completely different business with a magnificent economic cycle of its own: insurance. He bought National Indemnity Company, and then Geico. These were businesses that gushed cash, requiring little capital investment to grow. The cash from the dying textile winter was used to plant the seeds of an entirely new, vibrant financial spring. For years, he kept the textile business alive, a cash cow funding his expansion into superior ventures. Finally, in 1985, he penned a letter to his shareholders and closed the last of the textile operations. He didn't celebrate it as a victory, but acknowledged it with a sober respect for the powerful, impersonal economic cycles that made the decision inevitable. He had not defied history, he had harnessed it. He used the predictable decline of one industry to fund his rise in another, a masterclass in long-term investing and capital allocation. The psychological principle that blinds us to the inevitability of cycles is one of the most powerful and pervasive cognitive biases we possess: recency bias. Our brains are not wired for deep historical perspective. We are prediction machines designed for short-term survival. For our ancestors on the savannah, what happened in the last 24 hours, the location of a predator, the discovery of a fruit tree, was infinitely more important than what happened 10 years ago. Our minds naturally assign a greater weight and importance to recent events, and we unconsciously project those recent events indefinitely into the future. When a market has been rising for 5 straight years, our brain doesn't see it as the late stage of a bull market, a summer season that will inevitably turn to autumn. Our brain, hijacked by recency bias, sees a straight line pointing up and to the right and concludes that this is the new, permanent reality. The memory of the last crash fades, replaced by the vivid, immediate evidence of our neighbors getting rich on tech stocks or real estate. This bias is the fuel for every speculative bubble. During the dot-com boom, the fact that stock prices had become completely detached from a century of valuation norms was dismissed. Why? Because for the last 5 years, buying any stock with a .com in its name had been a winning strategy. The recent past screamed that this was the path to wealth, drowning out the faint, dusty warnings from the 1929 crash or the Nifty 50 bubble of the 70s. Recency bias convinces us that the fundamental laws of economics have been suspended. It creates the dangerous belief that we are in a, quote, new paradigm, a favorite phrase of bubble-era commentators. This is not a moral failing. It is a feature of our cognitive architecture. Overriding it requires a conscious, deliberate effort to zoom out, to ignore the compelling evidence of the last few years, and to actively study the evidence of the last few centuries. Buffett's mind does this automatically. When he sees a market soaring to new heights, his brain doesn't extrapolate the trend. Instead, he accesses a different data set, the historical record of previous peaks, the inevitable contractions that followed, and the long, cold economic winters that punished those who believed the summer would last forever. This deep respect for history is his antidote to the intoxicating poison of recency bias. To translate this deep historical understanding into a practical tool, we can develop what I call the economic seasons framework. This is a mental model, a blueprint for diagnosing the current state of the market cycle and adjusting your risk management and asset allocation accordingly. It requires you to stop thinking of the market as a random, unpredictable entity and start seeing it as a recurring, albeit irregular, four-season cycle. Step 1 is to learn the characteristics of each season. Spring is the season of recovery. It follows a market crash and a recession. The mood is one of pessimism and fear. Headlines are terrible. Unemployment is high. But beneath the surface, the seeds of the next boom are being sown. Interest rates are typically low, valuations are cheap, and the surviving companies are lean and efficient. This is the season of maximum opportunity for the contrarian investor. Summer is the season of expansion. The recovery takes hold and broadens into a healthy, sustained period of growth. Corporate profits are strong, unemployment falls, and confidence slowly returns to the market. The media narrative turns from pessimism to cautious optimism. Valuations move from cheap to fair. This is the longest and most pleasant season, the period where long-term investors make the bulk of their steady, compounding returns. Autumn is the season of euphoria. The long summer has convinced everyone that the good times will never end. Recency bias is now in full control. The market moves from healthy growth to speculative excess. Valuations become detached from fundamentals. New, unproven companies with compelling stories capture the public imagination and soar to absurd heights. The media is filled with stories of overnight millionaires. Caution is mocked as old-fashioned. Phrases like "new paradigm" and "this time is different" become common. Greed is the dominant emotion. This is the season of maximum risk. Winter is the season of contraction. The bubble pops. The catalyst can be anything: an interest rate hike, a geopolitical shock, a major corporate failure. But the result is the same. Asset prices fall, often with shocking speed. The euphoria of autumn turns into the fear and then panic of winter. Forced selling, margin calls, and liquidations create a downward spiral. The economy tips into recession. The media narrative becomes apocalyptic. This is the season of capital preservation for the prudent and the beginning of the hunting season for the patient value investor waiting for the return of spring. Step 2 is to build a dashboard of indicators to help you identify the current season. You don't need a complex algorithm. You need to track a few key, historically relevant data points. For example, valuation metrics. Use the Shiller P/E ratio or the Buffett indicator. Are they significantly above their long-term historical average? That's a sign of autumn. Are they well below? That's a sign of late winter or early spring. Investor sentiment. Look at the AAII Investor Sentiment Survey or the CNN Fear and Greed Index. Is there extreme greed? That's autumn. Extreme fear? That's winter. Credit spreads. Look at the difference in yield between high-yield junk bonds and safe government bonds. Are spreads razor thin, meaning investors have no fear of risk? That's autumn. Have they blown out, meaning investors are terrified? That's winter. Step 3 is to have a pre-written playbook for each season. In autumn, you are not trying to time the top. You are de-risking. You trim your most overvalued positions, you raise cash, you avoid leverage, and you ignore the siren song of FOMO. Your primary goal is capital preservation. In winter, you deploy that cash. You have a watch list of high-quality businesses you'd love to own, and you begin buying them as they go on sale, even as the headlines get worse. In spring and summer, you remain invested, letting your quality holdings compound, rebalancing periodically. This framework transforms you from a passive victim of the cycle into an active, strategic navigator. It provides a structure for your executive decision-making, ensuring that your actions are guided by historical probabilities, not by the fleeting emotions of the crowd. The antithesis to this disciplined, history-aware approach is the path walked by 99% of market participants, the path of the performance chaser. The performance chaser is the living embodiment of recency bias. Their entire investment strategy is based on buying what has just gone up the most. They see a sector like technology or a specific asset like cryptocurrency soaring, and the fear of missing out, the primal envy of seeing others get effortlessly rich, becomes an irresistible force. They don't ask about valuation, they don't study the business model, they don't consult economic history. Their only piece of due diligence is the recent price chart. And because they are late to the party, they inevitably arrive during the late autumn of the cycle. Consider the retail investor in 1999. For years, they had watched from the sidelines as tech stocks delivered astronomical returns. Their cautious, diversified portfolio of blue-chip stocks felt boring, archaic. Their neighbor, who knew nothing about business, was quitting his job to daytradepets.com. The pressure became unbearable, so they capitulated. They sold their boring value stocks and piled into the NASDAQ 100, buying companies with no earnings and nonsensical business plans at valuations that would make a 17th-century tulip speculator blush. For a few weeks, or maybe even a few months, they felt like a genius. The market continued its vertical ascent, validating their decision. They had finally joined the parade. But they had joined just as the parade was marching towards the edge of a cliff. When the winter of 2000 to 2002 arrived, the performance chaser was psychologically unprepared. Their entire thesis was based on the idea that these stocks only go up. When that thesis was shattered, they had no other anchor. They didn't own a piece of a business. They owned a ticker symbol that was now a source of excruciating daily pain. As the losses mounted from 20% to 40% to 60%, the initial denial gave way to raw, stomach-churning panic. They sold. They almost always sell near the bottom, at the point of maximum pessimism. In the depths of winter, they lock in catastrophic losses, vowing never to invest in the stock market again. In doing so, they not only destroy their capital, but they guarantee they will miss the subsequent spring and summer. The great irony is that their action, buying at the top, is what creates the peak of the bubble, and their action, selling at the bottom, is what creates the trough of the crash. They are not victims of the market cycle. They are the fuel that powers it. They are the human manifestation of the greed and fear that Buffett so skillfully exploits. The direct financial connection between understanding cycles and building wealth is the mathematical superpower of compounding, shielded by the armor of capital preservation. Let's look at two investors over a 20-year period. Investor A is a performance chaser. They are aggressive and get swept up in the cycles. In a roaring bull market, they might make 30%. But in the inevitable crash, they lose 40%. They repeat this pattern. Investor B is a student of history. They use the economic seasons framework. During the euphoric autumn, they de-risk and earn a modest 3%. During the winter, they avoid the big crash, perhaps losing only 5%. During the spring and summer, they earn a steady, solid 10% per year. The math of this is brutal and non-negotiable. After Investor A loses 40%, they need to gain a staggering 66.7% just to get back to where they started. The massive drawdowns are devastating to long-term compounding. Investor B, by avoiding the catastrophic loss, plods along. Their returns look less exciting in any single year, but over the full cycle, the difference is astronomical. The performance chaser's portfolio swings violently and ends up barely ahead of where it started. The history-aware investor's portfolio traces a steady, upward-sloping curve, the beautiful arc of uninterrupted compounding. This is the core of risk management. It's not about avoiding all risk. It's about avoiding the risk of permanent loss, the kind of loss that knocks you out of the game. By understanding the inevitability of winter, you ensure you have a coat, a shelter, and a supply of dry powder ready. When the blizzard hits and wipes out the unprepared, you are not only safe, but you are in a position of immense power. The ability to avoid the big mistake is a more potent financial advantage than the ability to find the next big winner. It is the quiet, unglamorous secret to building lasting financial freedom. The cycles will come and go. The discipline to respect them is what determines who is left standing when the seasons change. While the grand cycles of the economy provide the stage, the play itself is driven by a cast of characters whose script never changes: the human emotions of greed and fear. Warren Buffett's deep understanding of market history has taught him that while technologies, products, and political systems evolve, the fundamental wiring of the human brain remains stubbornly constant. We are the same emotionally driven creatures that chased Dutch tulips in the 1630s and South Sea stock in the 1720s. We are just doing it now with tech stocks and cryptocurrencies at the speed of light. This belief in the constancy of human nature is a cornerstone of his investment philosophy, and no story illustrates his ability to profit from it better than his masterstroke with American Express during the Great Salad Oil Scandal of 1963. The setting was a classic Wall Street panic. A small, seemingly insignificant company in New Jersey called the Allied Crude Vegetable Oil Refining Corporation, run by a man named Tino DeAngelis, had perpetrated a massive fraud. DeAngelis had borrowed enormous sums of money from various Wall Street firms, including a division of American Express, using his inventory of salad oil as collateral. The only problem was, the salad oil didn't exist. His massive storage tanks were mostly filled with seawater, with a thin layer of oil floating on top to fool the inspectors. When the fraud was discovered, Allied Crude collapsed, leaving its creditors, including American Express, on the hook for what was then a staggering sum, losses estimated to be as high as $60 million. The market's reaction was swift and brutal. American Express stock was annihilated. Wall Street panicked, assuming the company was ruined. The narrative was that the losses from the scandal would wipe out the company's net worth, and worse, that its reputation for trust and financial prudence was shattered forever. The herd was stampeding for the exit. Fear was in total control. This is where Buffett, a young, relatively unknown fund manager from Omaha, diverged from the crowd. He didn't just look at the stock price or listen to the panicked chatter of Wall Street analysts. He decided to investigate the fundamental reality of the business, which he understood was not its warehousing division, but the unshakable habit of its customers. He embarked on his own unique form of scripophily. He went out into the field, he visited restaurants, and asked waiters if customers were still using American Express cards. They were. He went to banks and asked tellers if people were still buying American Express traveler's checks. They were. He even talked to his competitors in the travel agency business, and they confirmed that their customers' faith in the American Express brand was completely unshaken. What Buffett realized was that the scandal, while a significant financial hit, was contained within the abstract world of Wall Street finance. It had not touched the core of American Express's business, which was its powerful, entrenched position in the minds of millions of consumers. The brand, the true source of the company's value, was a psychological fortress. People's habits, their trust in that little green card, were not going to change because of a bizarre scandal involving vats of salad oil. He concluded that the market, in its collective panic, was confusing a temporary, survivable financial problem with a mortal blow to the business franchise. He saw that human fear had created a massive gap between the price of the company and its true, long-term intrinsic value. So he acted. He invested 40% of his partnership's capital, a sum of $13 million, into American Express stock. It was the single largest investment he had ever made. Within 2 years, as the scandal faded from memory and the company's powerful earnings engine continued to churn, the stock price soared. Buffett's partnerships had made a profit of $20 million on their investment. He had not predicted earnings or analyzed a complex balance sheet. He had analyzed human nature and correctly bet that ingrained habit and brand loyalty were far more powerful forces than short-term market panic. The psychological engine driving the salad oil fiasco and nearly every market panic is a duo of powerful cognitive biases, social proof, and herd behavior. As a species, we are not wired for independent, contrarian thought. For hundreds of thousands of years, survival depended on sticking with the tribe. If everyone in your clan suddenly started running, the correct survival strategy was not to stop and analyze the situation. The correct strategy was to run first and ask questions later. The one who stayed behind to investigate whether the predator was real often became lunch. This instinct is burned into our deepest neural pathways. We are programmed to believe that what the crowd is doing is the right thing to do. This is social proof. When we are uncertain, we look to others for cues on how to behave. In the world of finance, this ancient instinct is a catastrophic liability. When a stock price is plummeting, the flashing red numbers trigger our primal fear response. We look around, and all we see is selling. The news headlines are apocalyptic. Financial commentators are predicting doom. Our friends are panic selling. Every social signal is screaming, "Run!" To stand against that stampede, to calmly step forward and begin buying while the herd is thundering past you in the opposite direction, feels profoundly wrong. It feels like you are the one who is crazy. It requires overriding one of the most powerful instincts we have. Herd behavior is social proof in action. It describes the tendency for individuals to mimic the actions of a larger group, whether those actions are rational or not. In markets, this leads to feedback loops that amplify both greed and fear. In a bull market, rising prices create stories of wealth, which attracts more buyers, which provides social proof that buying is the right decision, which pushes prices even higher. In a bear market, the cycle reverses. Falling prices create fear, which triggers selling, which provides social proof that selling is the right decision, which forces prices even lower. Buffett's mind seems to have a built-in circuit breaker for this instinct. He understands that the market crowd is not a source of wisdom. It is a source of raw, amplified emotion. When the herd is euphoric, he feels fear. When the herd is terrified, as they were with American Express, he feels a surge of intellectual curiosity. He knows that the point of maximum panic is also the point of maximum opportunity. His famous advice to be fearful when others are greedy, and greedy when others are fearful, is not just a clever aphorism. It is a precise, actionable instruction on how to systematically exploit the herd behavior of others for personal gain. It is the core of contrarian investing, a philosophy built entirely on the predictable irrationality of the crowd. To operationalize this contrarian philosophy, an investor needs a practical tool to measure the emotional state of the market. We can build what is known as the Fear and Greed Dashboard, a personal blueprint for diagnosing the prevailing sentiment and using it as a contrary indicator. This isn't about timing the market perfectly, but about tilting the odds dramatically in your favor by acting against the extremes of emotion. Step 1 of building your dashboard is to gather your indicators. You don't need dozens. You need a handful of reliable, historically tested measures of market sentiment. A good starting point would be 1. The VIX CBOE Volatility Index. Often called the Fear Index, the VIX measures the market's expectation of 30-day volatility. A very low VIX, below 15 for example, suggests extreme complacency and a lack of fear, a sign of greed. A very high VIX, above 30 or 40, signals high anxiety and panic, a sign of fear. 2. The CNN Fear and Greed Index. This is a pre-built composite indicator that tracks 7 different factors, including stock price momentum, junk bond demand, and put/call options ratios. It conveniently distills them into a single reading from 0, extreme fear, to 100, extreme greed. 3. Put/call ratios. This ratio measures the volume of bearish put options being traded versus bullish call options. A very high put/call ratio means traders are paying up for downside protection, indicating widespread pessimism and fear. A very low ratio indicates bullish complacency and greed. 4. Financial media analysis. This is a qualitative indicator. Are magazine covers celebrating a new bull market? are news channels running segments on how to become a day trading millionaire. This is the anecdotal evidence of widespread greed. Conversely are the headlines filled with words like crisis, collapse, and catastrophe. That is the unmistakable scent of fear. Step 2 is to track these indicators over time. Create a simple spreadsheet or use a financial data service. The goal is not to react to every daily wiggle, but to identify the extremes. You are looking for moments when all your indicators are flashing red for extreme greed or green for extreme fear. Step 3 is to have a predetermined course of action for when these extremes are reached. When your dashboard screams extreme greed, it is not a signal to short the market. It is a signal to increase your standards. You stop buying. You review your portfolio and trim positions that have become overvalued or have a weak competitive position. You might raise your cash allocation. You increase your margin of safety requirements for any new investment. Your default action is to do nothing, to patiently wait. When your dashboard screams extreme fear, your mindset shifts from defense to offense. You get your shopping list of high-quality companies you've always wanted to own, and see if any of them are now trading at a significant discount to their intrinsic value. You start to deploy your cash, not all at once but incrementally, as prices fall. You embrace the pessimism, knowing it is the source of your opportunity. This dashboard acts as a mechanical check on your own emotions. When you feel the pull of FOMO during a rally, the dashboard, showing extreme greed, serves as a stark reminder to be cautious. When you feel the icy grip of fear during a crash, the dashboard, showing extreme fear, gives you the analytical courage to act. It is a tool for enforcing the discipline of contrarian investing, for making Buffett's wisdom a systematic part of your financial life. The opposite of this disciplined contrarian approach is the path of the mania participant. This individual doesn't just chase performance, they become fully subsumed by the psychological vortex of a bubble. Their journey is a predictable 5-act tragedy that has been repeated in every mania, from the South Sea bubble of the 1720s to the crypto craze of the 2020s. Act 1. Skepticism and envy. Initially, the future mania participant dismisses the new, rising asset class. They call it a fad, a fraud, or a niche interest. But as the prices continue to rise, their skepticism is slowly corroded by the acid of envy. They see their friends, neighbors, and colleagues making what appears to be easy, effortless money. Their own prudence begins to feel like a foolish mistake. The pain of missing out becomes acute. Act 2. Capitulation and justification. The emotional pressure becomes too great. They surrender. They buy into the asset, often at a price far higher than they would have ever considered just months before. Immediately after buying, they become the asset's most fervent evangelist. They construct elaborate narratives to justify their purchase, talking about paradigm shifts, revolutionary technology, and how this time, the old rules of valuation simply don't apply. They are no longer an investor, they are a believer. Act 3. The paper millionaire. The bubble continues to inflate, and their position soars in value. They check their portfolio balance multiple times a day, intoxicated by the ever-increasing numbers. They begin to mentally spend their newfound wealth, planning for early retirement, luxury cars, and exotic vacations. They conflate being lucky in a bull market with being an investment genius. This overconfidence leads them to take on even more risk, perhaps buying on margin or concentrating even more of their net worth into the bubble asset. Act 4. The shock and denial. The bubble peaks and begins to deflate. The initial drop is dismissed as a healthy correction, a buying opportunity, or a shakeout of weak hands. The mania participant may even buy more, doubling down on their belief. They cling to the narrative they built in Act 2, unable to accept that the story might be wrong. They seek out confirming opinions from other believers in online forums and social media, creating an echo chamber of denial. Act 5. Panic and despair. The decline accelerates. The losses become too large to ignore. The 50% drop from the peak feels like a financial apocalypse. The narrative shatters, and the raw emotion of fear, which had been suppressed for so long, comes roaring back. The pain of further losses becomes unbearable. They sell. They capitulate for a second time, not at the top, but near the very bottom, often in a final cathartic wave of selling known as capitulation. They are left financially and emotionally broken, their belief in the markets shattered, often for a lifetime. This tragic journey is the direct consequence of surrendering to herd behavior. By tying their financial fate to the emotional whims of the crowd, the mania participant guarantees they will be on the wrong side of the trade at both the peak and the trough. The direct financial connection between understanding investor psychology and successful investing lies in one of the most powerful concepts in all of finance: buying assets for significantly less than their intrinsic value. The entire philosophy of value investing, pioneered by Benjamin Graham and perfected by Warren Buffett, is predicated on the fact that market prices, driven by the volatile emotions of human beings, frequently diverge from the true underlying worth of a business. It is human fear and greed that create these divergences. Greed creates bubbles, pushing the price of a popular company far above its intrinsic value. An investor who understands this avoids these companies, no matter how exciting their story. They know that buying an excellent company at a terrible price is a recipe for poor returns. Fear, on the other hand, creates panics. It can take a wonderful business with a temporary solvable problem, like American Express during the salad oil scandal, and put its stock on the bargain counter. This is where the magic happens. By being greedy when others are fearful, the value investor is able to purchase $1 of real, durable business value for 50 cents. This is the margin of safety that Benjamin Graham wrote about. It's not just a theoretical concept. It is a tangible financial advantage. When you buy a business for 50% less than it's worth, several wonderful things happen. First, you get significant downside protection. If you made a mistake in your valuation, or if the business encounters unexpected headwinds, that 50% cushion can absorb the impact and protect your principal. Second, you get a built-in tailwind for future returns. Even if the business's intrinsic value doesn't grow at all, your return will be spectacular as the price simply reverts from its panicked, irrational level back to its fair value. Third, and most importantly, it gives you the emotional fortitude to hold on during tough times. Knowing you bought your assets at a steep discount provides the confidence to ride out market volatility, secure in the knowledge that you have a fundamental anchor in reality that the rest of the market lacks. The ability to calmly analyze and act on the emotional mistakes of others is the ultimate source of alpha or market-beating returns. It is how you turn the market's greatest weakness, its susceptibility to mass delusion, into your greatest strength. Every dollar Buffett has ever made is a testament to this simple, profound truth. Every great market bubble in history, from the Mississippi scheme in 18th century France to the dot-com mania of the late 1990s, has been propelled by a single, intoxicating force, a powerful new era narrative. It's a story so compelling, so revolutionary, that it convinces millions of people that the fundamental laws of business and valuation have been repealed. Warren Buffett, a voracious student of business history, has an almost allergic reaction to these grand narratives. He understands that stories are for entertainment, profits and cash flow are for investing. His refusal to get swept up in the dot-com bubble, a decision for which he was mercilessly mocked at the time, stands as one of the most important foundational anecdotes of his career, a testament to his discipline in the face of mass delusion. The year was 1999. The Nasdaq was on a parabolic tear. Any company, no matter how flimsy its business model, could command a billion-dollar valuation simply by adding .com to its name. Financial television was a non-stop parade of newly minted 25-year-old millionaires and Wall Street analysts breathlessly explaining why price-to-earnings ratios were an outdated metric from a bygone era. Meanwhile, Warren Buffett and Berkshire Hathaway were sitting on the sidelines, holding billions in cash and investing in decidedly old economy businesses like insurance, furniture, and candy. The financial press was relentless. He was called a dinosaur, a washed-up has-been who didn't get it. Barron's ran a cover story with the headline, "What's Wrong, Warren?" The narrative was clear. The internet had changed everything, and Buffett's old-fashioned, value-based approach was dead. The pressure to capitulate must have been immense. His own shareholders were watching their neighbors get rich on stocks he refused to buy. But Buffett's anchor to history was stronger than the pull of the speculative tide. The climax of this drama came in July 1999 at the annual Sun Valley Conference, an exclusive gathering of media and technology moguls. Buffett was invited to speak, and the audience expected him to either defend his out-of-touch philosophy or, perhaps, to finally admit he was wrong. He did neither. Instead, he delivered a masterclass in economic history. He didn't talk about specific tech stocks, he talked about past technological revolutions. He took the audience back to the dawn of the 20th century and the rise of two world-changing industries, automobiles and aviation. He pointed out that at the turn of the century, there were over 2,000 car manufacturers in the United States. The automobile was undeniably the future. It would change society, create suburbs, and reshape the global economy. And yet, he asked, how many of those 2,000 companies had survived to create lasting value for their investors? The answer was a tiny handful. The vast majority went bankrupt. The industry as a whole was a terrible investment, a sinkhole for capital, despite being a technological triumph. He then turned to aviation. The Wright brothers' flight was one of the great achievements in human history. It shrunk the world and created a massive new industry. Yet, he noted, from the time of that first flight at Kitty Hawk until the 1990s, the net aggregate profit of every single U.S. airline combined was negative. Zero. All the money ever made by the airlines throughout their entire history had been lost. Again, a world-changing technology had been a disastrous investment for its owners. His message was devastatingly clear. A great new technology or a revolutionary industry is not the same thing as a great investment. The dot-com boosters were confusing the two. They were so mesmerized by the narrative of the internet's potential that they had forgotten to ask the most basic business question: how will this company make money, and what is a reasonable price to pay for those future profits? He was laying out the historical precedent. He was saying, I've seen this movie before and I know how it ends. 8 months later, in March of 2000, the Nasdaq peaked and began a collapse that would wipe out over $5 trillion in market value, vaporizing the paper fortunes of the very people who had mocked him. Buffett hadn't needed a crystal ball, he just needed a history book. The psychological trap that ensnares investors during these periods is known as the narrative fallacy, a term coined by Nassim Nicholas Taleb. Our brains are not built to process raw, disconnected facts and data. We are story-processing machines. We crave narratives because they help us make sense of a complex and chaotic world. A good story provides a simple explanation of cause and effect, it creates order out of randomness, and it feels emotionally satisfying. The narrative of a new era technology is the most seductive story of all. It speaks to our innate optimism and our desire to be part of something big and revolutionary. The story of the internet was about connecting the entire world, democratizing information, and creating a frictionless global marketplace. It was a beautiful, powerful, and, in many ways, true story. The fallacy occurs when we allow this compelling narrative to substitute for rigorous financial analysis. The story is so good that we stop asking hard questions. Does this company have a sustainable competitive advantage? Does it have a clear path to profitability? Is its valuation even remotely tethered to a plausible stream of future cash flows? The narrative becomes a cognitive shortcut that allows us to bypass the difficult, boring work of due diligence. When someone bought shares in a company like Webvan, the online grocery delivery service that was valued at over $7 billion in 1999 before going bankrupt, they weren't buying a piece of a logistics business with complex supply chains and thin profit margins. They were buying a piece of the future of retail narrative. The story was clean and exciting. The balance sheet was messy and terrifying. The narrative fallacy explains why people will pay absurd prices for a company with a great story but no profits, while ignoring a boring, profitable company in an unglamorous industry. The boring company has no narrative appeal. Buffett's genius lies in his immunity to this fallacy. He is a master at separating the story of a business from the economics of a business. He loves a great business, but he is completely indifferent to a great story if the numbers don't back it up. He inverts the process. While most investors start with the exciting story and then try to fit the numbers to it, Buffett starts with the numbers: profitability, return on capital, debt levels. And only if they meet his stringent criteria will he even begin to consider the qualitative story of the business. This disciplined, story-agnostic approach is the ultimate defense against the most expensive and alluring trap in the investment world. To arm yourself against the siren song of seductive market narratives, you need a systematic process for deconstructing them. We can call this the narrative deconstruction checklist, a blueprint for applying Buffett's historical skepticism to any investment idea, especially the ones that seem most exciting. This is an essential tool for any entrepreneur or investor engaged in high-level executive decision-making. Step 1. Identify the core narrative. Before you do anything else, articulate the story in a single, compelling sentence. For Tesla, it might be, Tesla is leading the global transition to sustainable energy and autonomous transportation. For a new biotech company, it might be, this company has discovered a cure for a major disease that will change medicine forever. Write it down. Acknowledge its power. Step 2. Find the historical analog. This is the Buffett move from Sun Valley. Dig into business history and find a parallel. Is this new technology being hyped like the railroads in the 19th century? Like the radio in the 1920s? Like the personal computer in the 1980s? Study how those historical analogs played out. How many companies were created? How many survived? Was the industry as a whole a good investment for its initial backers? This exercise provides a crucial dose of historical sobriety. Step 3. Mute the narrative and analyze the numbers. Now pretend you know nothing about the company's story. You are given only its financial statements, the income statement, the balance sheet, and the cash flow statement for the last 5 years. Do you see a business with growing revenues? More importantly, do you see growing profits and free cash flow? How much debt does it have? What is its return on invested capital? If the numbers, in isolation, do not paint a picture of a strong, profitable, and durable business, then the narrative is likely just a fantasy. This is the most crucial step in beating the narrative fallacy. Step 4. Stress test the assumptions. Every grand narrative contains a set of implicit assumptions about the future. For the future of retail narrative, the assumption was that customers would be willing to pay a premium for online delivery that would cover the immense logistical costs. For many new technologies, the assumption is that the company will achieve a near-monopoly market share in a massive total addressable market, TAM. Your job is to identify these assumptions and attack them. What if competition is fiercer than expected? What if consumer adoption is slower? What if the profit margins in this new industry are razor-thin? Quantify how a change in these assumptions would affect the company's valuation. Step 5. Invert the problem. Instead of asking, how could this succeed, ask Charlie Munger's favorite question, how could this fail? List all the potential failure points. Could the technology be rendered obsolete by something even newer? Could regulators step in? Could the company run out of cash before it reaches profitability? This process of inverting forces you to confront the risks that the exciting narrative encourages you to ignore. By systematically running every new investment idea through this 5-step checklist, you build a powerful intellectual moat around your capital. It allows you to appreciate a good story without letting it hijack your wallet, ensuring your investment decisions are grounded in economic reality, not in popular fantasy. The antithesis to this rigorous deconstruction is the path of the 99%, constantly chasing the next big thing. This investor is not just a participant in a single mania, Their entire philosophy is built on jumping from one hot narrative to the next. Their portfolio is a graveyard of once exciting stories that ended in financial disaster. In the early 2010s, their portfolio was filled with 3D printing stocks. The narrative was powerful: a 3D printer in every home, revolutionizing manufacturing from the ground up. Stocks like 3D Systems and Stratasys soared to incredible heights. But the consumer adoption never materialized, and the industrial applications proved to be a slower, more competitive grind than the story suggested. The stocks collapsed, losing over 90% of their value. Before the ashes were even cold, the narrative chaser was on to the next story: cannabis. Legalization was sweeping the nation, creating a massive new market out of thin air. The narrative was about grabbing a once-in-a-generation opportunity to invest in the new alcohol or new tobacco. Companies with Canadian stock tickers and little revenue were commanding multi-billion-dollar valuations. But the reality of high taxes, black market competition, and oversupply quickly set in. The cannabis stock bubble burst, incinerating the capital of those who had bought into the hype. From there, the chase continued, to vegan meat substitutes, to the metaverse, to any number of disruptive technologies that promised to change the world but had yet to produce $1 of profit. The common thread is that this investor is buying a lottery ticket, not a business. They are investing in a story, a dream of what a company could become, rather than the reality of what it is. They are paying a massive premium for hope. This approach is the polar opposite of a sound asset allocation strategy. Instead of diversifying and focusing on proven, profitable business models, they concentrate their bets on the most speculative and unproven corners of the market. They are attracted to companies with high cash burn rates, mounting debt, and a constant need to raise more capital by issuing new shares. They are essentially funding a science experiment, and the overwhelming majority of experiments fail. They are perpetually drawn to the sizzle, never bothering to check if there is any stake. This path is not just financially ruinous, it's emotionally exhausting, a constant cycle of hope and despair, chasing narratives that always seem to dissolve just as you grasp them. The direct financial connection between ignoring narratives and building wealth is a relentless focus on a company's demonstrated, durable earnings power. A narrative is an intangible story about the future. Earnings power is the cold, hard cash a business generates for its owners right now, and has generated consistently in the past. While a story can be endlessly debated, free cash flow is an indisputable fact on a financial statement. Let's compare the financial anatomy of a typical story stock versus a classic Buffett-style business. The story stock's income statement often shows rapidly growing revenue, which is the source of the excitement. But further down, you'll see massive spending on marketing and research, leading to a large and growing net loss. The narrative justifies this by saying the company is investing for growth. On its balance sheet, you will often find very little cash and a large, growing mountain of debt, or alternatively, a constantly increasing number of shares outstanding from repeated capital raises. Its cash flow statement is the real horror show, a huge negative number under cash from operations, indicating the core business is burning through money at a terrifying rate. This cash burn is funded by cash from financing, which is the money raised from new investors who have bought into the story. It is a financial vampire, surviving only by constantly sucking in new capital. Now, look at a Buffett-style business like See's Candies or the Washington Post in its prime. The income statement shows steady, predictable revenue growth and, more importantly, thick, consistent profit margins. The balance sheet is a fortress, with little to no debt and a large pile of cash. The cash flow statement is a thing of beauty, a large positive number under cash from operations year after year. This business doesn't consume cash, it gushes cash. It is a financial fountain. By focusing on the latter and completely ignoring the former, no matter how compelling its story, Buffett builds a portfolio of incredible financial resilience. His companies don't depend on the kindness of capital markets to survive. They are self-funding engines of wealth creation. This focus on proven earnings power is the ultimate form of risk management. It ensures that the companies you own are built on a foundation of economic reality, not on the shifting sands of a popular narrative. The financial advantage is twofold. You avoid the catastrophic losses that come when a popular narrative implodes, and you get to own businesses that generate the cash that ultimately funds dividends, buybacks, and the acquisitions that build true, lasting financial freedom. In the world of investing, there is a constant tension between the timeless and the timely. The timely is the chatter of the day, the hot stock, the new technology, the latest economic forecast. The timeless are the fundamental principles of value that have governed commerce for centuries. Warren Buffett's genius is his unwavering commitment to the timeless, using historical valuation metrics as his anchor in the turbulent sea of market sentiment. This principle was on brilliant display during his 1973 purchase of the Washington Post Company. The historical context is crucial. The early 1970s were a difficult time for the stock market. The country was mired in the Vietnam War, an oil crisis, and rising inflation. But within this gloomy market, there was a specific pocket of euphoria: the Nifty 50 era. This was a group of 50 large, high-growth stocks like Xerox, Polaroid, and Avon that were considered so wonderful, so dominant, that they were good investments at any price. Wall Street had adopted a new era narrative that these one-decision stocks could be bought and never sold. Their price-to-earnings ratios soared to 50, 80, even 100. Meanwhile, the rest of the market, solid, profitable, but less glamorous businesses, was left for dead. The Washington Post was one of these forgotten companies. It was a magnificent business franchise. It had a virtual monopoly on the newspaper market in the nation's capital, a powerful television station, and ownership of Newsweek magazine. Its journalism, particularly its recent coverage of the Watergate scandal, was legendary. Yet in the market crash of 1973-74, its stock price was hammered, falling by nearly 50%. While the rest of Wall Street was chasing the Nifty 50, convinced that growth at any price was the only game in town, Buffett did what he always does. He pulled out his historical yardsticks. He didn't just look at the stock price, he calculated the value of the entire business. He analyzed its decade-long history of earnings, its return on capital, and its formidable competitive moat. He realized that at the current stock price, the entire market capitalization of the Washington Post Company was about $80 million. Buffett, with his deep understanding of media assets, did a quick, conservative valuation and concluded that the business was actually worth at least $400 million and perhaps as much as $500 million. The market was offering him $1 of prime, world-class business value for just 20 cents. The reason for this absurd discount was purely emotional. The market was in a state of fear and pessimism, and investors were infatuated with the Nifty 50 narrative, ignoring everything else. Buffett ignored the sentiment and the narrative. He trusted his historical valuation work. Over the course of 1973, Berkshire Hathaway invested nearly $11 million to acquire a large stake in the company. That investment, which the market at the time considered a bet on a dying old media industry, would become one of the cornerstones of Berkshire's success. By 2007, that $11 million stake was worth over $1.5 billion, a return of more than 100-fold. This was not a lucky bet on a hot stock. It was the calculated, disciplined application of timeless valuation principles at a moment when the rest of the world had forgotten them. He used history as his guide, and it led him to one of the greatest investments of all time. The psychological bias that allows for these incredible opportunities to exist is known as anchoring bias. This is our brain's tendency to rely heavily on the first piece of information offered, the anchor, when making decisions. In markets, the most common anchor is a stock's recent price. This creates powerful distortions in our perception of value. For example, if a speculative stock that was trading at $300 a month ago falls to $150, our brain, anchored to the $300 price, perceives the stock as, quote, cheap. It feels like it's on a 50% off sale. However, a rigorous analysis of its intrinsic value might reveal that the business is only worth $20 per share. It's not cheap at all, it's still wildly expensive. The investor anchored to the recent price is tricked into buying, while the investor anchored to intrinsic value stays away. Anchoring bias works in the other direction during bubbles. As a stock rises from $100 to $200 to $300, each new high becomes the new anchor, making the next move to $400 seem plausible. The longer the trend continues, the more detached from reality the anchor becomes. Buffett's method is a conscious and deliberate strategy to overcome this bias. He rejects recent price action as a valid anchor. Instead, he creates his own anchors, forged from deep historical data and conservative business analysis. His anchors are not based on what a stock traded for last week, but on fundamental, timeless metrics. What is the average price-to-earnings ratio for this type of business over the last 50 years? What is the replacement cost of its assets? What is the discounted value of its future cash flows? By creating these rational, history-based anchors, he liberates himself from the emotional pull of recent market action. When he looked at the Washington Post, Wall Street was anchored to its falling stock price and the gloomy economic headlines. Buffett anchored his thinking to the company's decade-long history of dominant earnings power and its unassailable competitive position. His anchor was based on business reality, theirs was based on market fear. This is a subtle but profound mental shift. Most investors ask, where is the stock price going? Buffett asks, what is the business worth? The first question anchors you to the volatile and irrational sentiment of the market. The second anchors you to the stable long-term reality of the business. Choosing the right anchor is one of the most critical decisions an investor can make. To put this into practice, any serious retail investor or entrepreneur can create their own historical value dashboard. This is not a tool for predicting short-term market moves, but a simple, powerful blueprint for maintaining a long-term perspective on valuation and avoiding the trap of anchoring to current sentiment. It consists of tracking a few key macro-level valuation indicators and comparing them to their long-term historical averages. Your dashboard should include 1. The Shiller P/E ratio, or CAPE ratio. This measures the price of the S&P 500 divided by the average of 10 years of inflation-adjusted earnings. By smoothing out earnings over a full business cycle, it gives a much more reliable picture of valuation than the standard P/E ratio. Track the current CAPE ratio and compare it to its long-term historical average, which is around 17. When the CAPE ratio is well above 30, as it was in 1929 and 2000, it signals that the market is historically expensive and future long-term returns are likely to be low. This is a powerful anchor to reality. 2. The Buffett indicator. This is Warren Buffett's favorite macro valuation tool. It is the total market capitalization of all U.S. stocks divided by the country's gross national product, or gross domestic product. Buffett has called it probably the best single measure of where valuations stand at any given moment. Historically, a ratio around 70 to 80% is considered fair value. When it climbs above 150% or 200%, it's a screaming signal that the market has become detached from the underlying economy, a clear sign of a bubble. 3. Price-to-book ratio of the S&P 500. This compares the market price of the index to the combined net asset value of all its companies. While less relevant for tech-heavy economies than it used to be, it still provides a useful historical anchor, especially at its extremes. Tracking its level versus its 50-year average gives you another data point on whether you are paying a historically high or low price for a piece of corporate America. 4. Dividend yield versus interest rates. Compare the dividend yield of the S&P 500 to the yield on a 10-year U.S. Treasury bond. The TINA, there is no alternative argument, often surfaces when interest rates are low, justifying high stock valuations. But historically, when the S&P 500's dividend yield, is significantly below the yield on safe government bonds, it's a sign that investors are not being adequately compensated for the additional risk of owning equities. By creating a simple chart or spreadsheet to track these four metrics on a monthly basis, you build a powerful defense against anchoring bias. When a friend tells you stocks have to go up, but your dashboard shows the Buffett indicator at 200% of GDP and the Shiller PE at 35, you have an immediate, data-driven antidote to their narrative. This dashboard doesn't tell you what the market will do next week. It tells you how much risk you are taking on for the potential rewards based on 100 years of financial history. It is the ultimate tool for long-term strategic asset allocation. The antithesis of this history-based valuation approach is a phenomenon that appears in every speculative mania, the invention of new metrics to justify insane prices. When traditional valuation methods like the price-to-earnings ratio start to flash red, the proponents of a bubble don't question their beliefs. They invent new yardsticks that make the bubble look rational. It is an act of intellectual dishonesty designed to keep the party going. The dot-com bubble was the golden age of this practice. How do you justify a multi-billion-dollar valuation for a company with no revenue, let alone profit? You can't use a P/E ratio because there are no earnings. So Wall Street invented a whole new lexicon of metrics. Instead of price to earnings, they talked about price to eyeballs, valuing companies based on the number of visitors to their website. They used price to clicks, as if every click was a guaranteed future sale. The most pervasive metric was TAM, the total addressable market. An analyst would claim that online pet food was a $20 billion TAM, and that if a company called Pets.com could just capture 10% of that market, it would be a $2 billion business, thus justifying its current valuation. It was a fantasy built on a fantasy. These metrics shared a common feature. They were all focused on some distant hypothetical future, and they all conveniently ignored the current, disastrous reality of the business's finances. They were instruments of storytelling, not of analysis. The path of the 99% is to embrace these new metrics. It feels sophisticated. It feels like you're part of the new paradigm. You learn the new jargon and repeat it at cocktail parties, feeling like an insider. But what you are really doing is participating in a collective delusion, a suspension of the timeless laws of finance. After every bubble bursts, these new metrics vanish without a trace. In the brutal winter of a bear market, no one talks about price to eyeballs anymore. The only metric that matters is the one that has always mattered: profit. Cold, hard, distributable cash. The companies that have it survive and eventually thrive. The companies that were valued on new era fantasies go bankrupt. By clinging to the historical valuation metrics that have stood the test of time, you make yourself immune to this semantic deception. You let others chase the phantoms of eyeballs and TAM, while you stick to the tangible reality of earnings, cash flow, and a strong balance sheet. The direct financial connection of using historical valuation is the creation and disciplined application of a margin of safety. This concept, the cornerstone of Benjamin Graham's philosophy, is the single most powerful principle for capital preservation and long-term financial success. The margin of safety is the difference between the intrinsic value of a business and the price you pay for it in the market. It is a simple idea with profound consequences. First, you must calculate a conservative estimate of a business's intrinsic value. This is your anchor, based on its historical earnings power, its assets, and a reasonable projection of its future. Let's say you analyze a solid, stable company and conclude its intrinsic value is $100 per share. The margin of safety principle dictates that you do not buy the stock at $95 or $90 or even $80. You wait patiently until the market, in a fit of pessimism or neglect, offers it to you for $60 or $50 or even less. That gap, that $40 or $50 difference, is your margin of safety. This margin provides three critical financial advantages. First, it is a buffer against error. Your valuation of $100 might be wrong. You might have been too optimistic. But if you buy at $50, the business can turn out to be worth only $70. and you still make a handsome profit. It gives you room to be human, to make mistakes, without suffering a catastrophic loss. Second, it is a buffer against bad luck. The world is an unpredictable place. A new competitor might emerge. A recession might hit. A key executive might leave. These unforeseen events can impair a company's value. A large margin of safety ensures that even if the business suffers a setback, your initial purchase price was so low that you can still come out whole or with a small profit. Third, it is the engine of superior returns. The beauty of buying with a large margin of safety is that you don't need the business to perform miracles to do well. Your primary return comes from the price simply closing the gap back to its current intrinsic value. Any future growth in the business is just icing on the cake. By refusing to invest without a significant margin of safety, you are fundamentally changing the nature of the game. You are moving from speculation to business-like investing. You are making it so that you only need to be about right to make money, while protecting yourself from the permanent capital impairment that destroys the path to financial freedom. This discipline, rooted in a deep respect for historical valuation, is what separates the fleeting speculator from the enduring wealth builder. Warren Buffett is not a sui generis genius who conjured his investment philosophy from thin air. He is, first and foremost, a student. He is the product of a deliberate and lifelong study of the great business minds and market events that came before him. His entire operating system is built upon a foundation laid by his mentor, Benjamin Graham, and fortified by the harsh lessons of the Great Depression. Understanding this lineage is crucial to understanding Buffett, for it reveals that his wisdom is not magic. It is the accumulated knowledge of history, internalized and applied with supreme discipline. The foundational anecdote here is not a single transaction, but the transformative discovery that set a young Warren Buffett on his life's path. As a student at Columbia University, he stumbled upon a book that would become his Bible, The Intelligent Investor, by Benjamin Graham. For Buffett, reading this book was like finding a roadmap in the wilderness. It was a revelation. But what Buffett absorbed was not just a set of formulas for buying cheap stocks. He absorbed the entire historical and psychological context from which Graham's ideas were born. Benjamin Graham was not an academic theorist. He was a battle-hardened practitioner whose investment philosophy was forged in the crucible of the 1929 stock market crash and the decade-long Great Depression that followed. He had witnessed firsthand how the speculative euphoria of the 1920s, with its new era narratives and abandonment of historical valuation, had led to absolute financial annihilation. He had seen stocks of the era's best companies fall by 90% or more. He had seen fortunes vaporized and lives ruined. Graham's principles, the concept of Mr. Market, the demand for a margin of safety, the insistence on viewing a stock as a piece of a business, were not clever ideas. They were survival tools. They were the intellectual armor he had constructed to protect himself and his clients from the devastating emotional and financial consequences of another market mania. When Buffett read Graham, he wasn't just learning finance. He was vicariously experiencing the trauma of the Great Depression. He was learning about the danger of leverage, the folly of speculation, and the supreme importance of capital preservation from a man who had seen it all firsthand. This is a profoundly different way of learning than simply memorizing a formula. Buffett didn't just learn what Graham thought, he understood why Graham thought it. He understood that the margin of safety was not just a way to get better returns. It was a non-negotiable defense against the recurring madness of mankind. This deep historical empathy gave him a perspective that his peers, who had only ever known the post-war bull market, could never possess. While they saw the market as a source of easy riches, Buffett, through his study of Graham, saw it as a dangerous and seductive beast that had to be approached with extreme caution, discipline, and a deep respect for its history of devastating investors who forgot its lessons. His entire career is a testament to the power of learning from the triumphs and, more importantly, the mistakes of the past. The psychological principle at play here is a powerful antidote to one of our most dangerous cognitive flaws. The flaw is the availability heuristic, our tendency to make judgments about the likelihood of an event based on how easily we can recall examples of it. For the average investor whose experience is limited to the last 5 or 10 years, the most readily available mental images are of a rising market. Bull markets, by their nature, last longer than bear markets. Therefore, the memories of profits, easy gains, and new highs are fresh and vivid. The memory of the last terrifying crash, however, is distant and faded. The availability heuristic makes them psychologically unprepared for a severe downturn because a crash is not an available concept in their recent experience. They become complacent, overconfident, and they take on far too much risk. By deliberately and systematically studying the great crashes of history, 1929, 1973, 1987, 2000, 2008, you are performing a crucial mental exercise. You are intentionally making the concept of a market collapse more mentally available. You are searing the images of those historical panics into your mind, making them just as vivid as the recent memory of a bull run. This is a form of psychological pre-mortem. When you read in detail about the ruin of speculators in the 1929 crash, you vicariously feel their pain. When you study the failure of long-term capital management, you experience the arrogance and ultimate downfall of supposed geniuses. This isn't about being pessimistic, it's about being realistic. It serves as a powerful vaccination against the virus of euphoria. When the next bubble inflates, and everyone around you is convinced that this time is different, your mind, armed with a rich library of historical failures, will immediately recognize the pattern. The availability of these historical precedents acts as an automatic brake on your own greed. It injects a dose of healthy fear and skepticism into your decision-making process, compelling you to check valuations, to demand a margin of safety, and to resist the pull of the herd. Buffett's mind is a veritable encyclopedia of business and market history. When he evaluates a new situation, he is not just drawing on his own personal experience. He is drawing on centuries of vicarious experience. This vast, readily available dataset of past failures is his ultimate risk management tool. To cultivate this historical mindset, you need a structured approach. You can create what I call the Vicarious Investor Program, a self-directed curriculum designed to give you a century of market experience without having to suffer a century of market losses. It's a blueprint for building the deep historical knowledge that underpins all of Buffett's decisions. The program has 4 phases. Phase 1, the foundation. You must begin where Buffett began, with Benjamin Graham. Read, The Intelligent Investor. Do not just skim it. Study it. Pay special attention to Chapter 8 on Mr. Market and Chapter 20 on the margin of safety. This book provides the immutable, foundational principles of value investing, born from the ashes of the Great Depression. It is the constitution upon which all sound investing is built. Phase 2. The study of manias. Once you have the foundation, you must study the follies. Read Charles Mackay's Extraordinary Popular Delusions and the Madness of Crowds, focusing on the chapters on the South Sea Bubble and tulipomania. These stories, though centuries old, are perfect analogues for every modern bubble. Then read John Kenneth Galbraith's The Great Crash, 1929. Galbraith was not just an economist, but a brilliant writer who captures the social and psychological atmosphere of the 1920s boom and the subsequent bust. This phase teaches you to recognize the recurring patterns of human behavior at market extremes. Phase 3. Learning from the masters. Now you study the practitioners who successfully navigated these cycles. The single best resource in the world is the collection of Warren Buffett's annual letters to Berkshire Hathaway shareholders. They are a masterclass in clear thinking, business analysis, and long-term perspective, written for the layman. Read them chronologically to see how his thinking evolved. Then, expand to other great capital allocators. Read The Outsiders by William Thorndike, which profiles 8 unconventional CEOs who excelled at capital allocation and created immense value for shareholders. Phase 4. The study of failure. it is just as important to learn from catastrophic mistakes as it is from successes. Read When Genius Failed by Roger Lowenstein, the story of the collapse of long-term capital management. This is a terrifying cautionary tale about how brilliance, leverage, and a belief that history no longer applies can lead to ruin. Also, read The Smartest Guys in the Room, the story of Enron, to understand how corporate fraud can be hidden behind a compelling narrative and complex accounting. By dedicating yourself to this structured reading program, you are rewiring your brain. You are replacing the short-term biased dataset of your own limited experience with a vast, robust dataset spanning centuries of business and market history. You will begin to see the present not as a unique and unprecedented moment, but as an echo of the past, allowing you to act with a wisdom and perspective that is simply unavailable to the 99% of investors who refuse to read. The antithesis of this humble, student of history approach is the genius complex. This is an affliction that often strikes investors, particularly those who are intelligent and have had a string of early successes in a bull market. They begin to believe that their success is due to their own unique brilliance, rather than the simple luck of being in a rising market. They start to believe they are the exception to the rule. This overconfidence leads them to dismiss the lessons of history and the wisdom of investors like Buffett and Graham as outdated and irrelevant. They think that margin of safety stuff was fine for the industrial economy of the 1930s, but it doesn't apply to the fast-moving, technology-driven economy of today. They believe their superior intelligence or their deep understanding of a new technology allows them to defy the historical laws of financial gravity. The most spectacular example of the genius complex in modern financial history is the story of long-term capital management, or LTCM. The firm was founded in 1994 by a dream team of Wall Street's brightest minds. It included John Meriwether, the legendary bond trader from Salomon Brothers, and, most notably, two Nobel Prize-winning economists, Myron Scholes and Robert C. Merton, whose options pricing models were the bedrock of modern financial theory. Their strategy was to use complex mathematical models to exploit tiny, temporary pricing discrepancies in global bond markets. Because the profits on each trade were minuscule, they had to use an astonishing amount of leverage, borrowing over $25 for every $1 of their own capital to generate attractive returns. Their core belief was that their models, built by Nobel laureates, had essentially solved the problem of risk. They saw market history not as a guide to human folly, but as a data set from which to build infallible models. They believed they were smarter than the market and its history. For 4 years, they were stunningly successful, generating annual returns of over 40%. But in 1998, when Russia defaulted on its debt, a series of market events occurred that their models had predicted were statistically impossible, a 10 sigma event that shouldn't happen in the entire life of the universe. The global financial system seized up, and the tiny pricing discrepancies they were exploiting suddenly became massive, gaping wounds. Their leveraged bets turned against them with catastrophic force. In a matter of weeks, the firm lost over $4.6 billion, bringing the entire global financial system to the brink of collapse and requiring a massive, coordinated bailout by the Federal Reserve. The geniuses had failed. Their complex models were no match for the raw, primal force of a global panic. They had ignored the most important lesson of history, that the improbable happens, and that leverage is the weapon that turns a manageable loss into a fatal one. The genius complex is the ultimate form of believing this time is different. It is the belief that I am different. It is an arrogance that history has punished, without exception, time and time again. The direct financial connection of learning from the past is the construction of a truly resilient investment portfolio and a durable lifelong philosophy. A portfolio built without regard for history is like a house built in a floodplain with no foundation. It may look beautiful during the sunny years, but the first great storm will wash it away. A portfolio built on the wisdom of history is designed, from the ground up, to withstand the inevitable storms. This resilience manifests in several tangible financial ways. First, it leads to a prudent asset allocation. A student of history knows that no single asset class remains dominant forever. They will diversify across stocks, bonds, and perhaps real assets, not just because a textbook tells them to, but because they have studied the lost decade for stocks in the 2000s or the brutal bear market in bonds in the 1970s. Second, it enforces a strict aversion to leverage. Having studied the downfall of LTCM and the speculators of 1929, the history-aware investor treats debt with extreme caution. They know that leverage turns a recoverable mistake into a bankruptcy. They prioritize survival above all else. Third, it cultivates a focus on quality. A student of history knows that in a crisis, the flimsy, unprofitable speculative companies are the first to perish. The market's flight to quality is a recurring historical phenomenon. Therefore, they build their portfolio around businesses with strong balance sheets, durable competitive advantages, and a long history of profitability. The businesses that have the financial fortitude to survive a winter and dominate the subsequent spring. The ultimate financial result of this approach is not necessarily the highest possible return in a raging bull market. The genius complex investor, with their leveraged bets on hot stocks, will almost certainly outperform in the late stages of a bubble. But the goal of the vicarious investor is not to win a single, speculative sprint. It is to win the multi-decade marathon of wealth compounding. The financial advantage is found in what the portfolio doesn't do. It doesn't suffer the 50% or 60% drawdowns that cripple a portfolio for years. It avoids the permanent loss of capital that knocks an investor out of the game entirely. This strategy may seem conservative, even boring during times of market euphoria. But over a full market cycle, over a lifetime of investing, it is the most powerful and reliable path to achieving true and lasting financial freedom. It is the difference between a strategy for getting rich slowly and a strategy for getting poor very, very quickly. You have just spent this time acquiring one of the most powerful mental tools an investor can possess. You have been given the historical lens, the ability to look at the market chaos and media hype of today and see the clear, unmistakable echoes of the past. You now understand that the cycles of fear and greed are not a modern phenomenon, but a permanent feature of the financial landscape, driven by a human nature that does not change. You can now recognize the seductive new era narratives and the flimsy valuation metrics that accompany every bubble, not with naive excitement, but with the sober wisdom of someone who has seen this play out 100 times before. This is a profound advantage that will protect your capital from the manias that ruin the majority. But recognizing the pattern is only the first step. The true masters of the market, like Buffett, don't just see the cycle. They have a precise, repeatable system for acting on it. They know exactly what to buy when fear is at its absolute peak, and bargains are everywhere. They don't just avoid the bubble, they methodically profit from the panic that follows. The next piece of this map, the video that is on your screen right now, isn't just another idea. It is the action plan. It is the bridge from knowing history to using history. It moves beyond the why and into the specific what. It details the rigorous financial criteria, the non-negotiable checklist of business quality and financial strength that Buffett uses to pull the trigger when everyone else is paralyzed by fear. You have already proven that you are the kind of person willing to learn the hard-won lessons of the past. The question now is, are you ready to learn how to actively profit from them? The choice to continue is not just about watching another video. It is a conscious decision to move from being a student of market history to becoming a practitioner of contrarian investing. It's about completing your mental arsenal. The next critical link in the chain is waiting. Click the video and continue your ascent.